Inox Wind or Suzlon Energy, which is the best company in the wind energy space that can give you maximum returns. In the last episode, I'd broken down the fundamentals of Suzlon Energy, and now I'll analyze Inox Wind for you. So stay tuned till the end of this video to know all about it. Inox Wind's share price has more than doubled in just a year's time, and here we check out the company's outlook. Up first is the stock performance. The company's stock has surged over 45% in the last 6 months and around 144% over the past 1 year. However, it has fallen around 6% over the past month. Is that a concern? Well, let's see. Let's break down the company's business. Inox Wind is a part of the Inox Group and is engaged in the business of manufacturing wind turbine generators as well as providing energy solution services. With a strong track record of over 13 years, the company is a fully integrated player that provides end-to-end turnkey solution. Inox Wind has a manufacturing capacity of over 2.4 gigawatts, which is spread across 4 facilities. Before I get into a more detailed description of the company and its growth potential, it is important to break down the structure. Inox Wind has 2 subsidiaries that make it a truly integrated player. The first one is Inox Green Energy Services, which is a listed entity, and it offers operation and maintenance services for wind farms. The second one is Resco Global Wind Services, which is not listed and provides engineering, procurement, and construction services for wind projects. Key thing to be noted is that the group is in the process of demerging and listing Resco Global separately. So what's next for Inox Wind? Well, the company's current order book stands at over 3 gigawatts, which gives the company revenue visibility of 2 years. Management is confident about reaching its execution target of 800 megawatts in FY25 and 1.2 gigawatts and 1.8 gigawatts in FY26 and FY27 respectively. While the first half of the current fiscal saw low execution, the company states that 65 to 70% of its targeted FY25 execution will come in the second half of the current fiscal. As per Newama research, the company remains a key player in the commercial and industrial segment and stands to benefit from low competition in the wind EPC space. The aim is to capture 30% market share in the wind turbine as well as the wind EPC segments over the next 2 to 3 years. Also, India's goal is to add 80 gigawatts of wind capacity over the next 8 years, and the company is expected to benefit from this in a big way. On its part, Inox Wind will be adding new 800 megawatts of nacelle capacity by February 2025 to meet the growing demand, and is also evaluating 2 incremental plants for blades to help logistic costs. Furthermore, Inox Wind and its 2 subsidiaries will also be beneficiaries of the synergies of the group's latest solar manufacturing venture that is expected to come on stream by March 2025. This will help the company secure more orders in the round-the-clock and the firm and dispatchable renewable energy segments. With so much going on, will there be plain sailing? Here we decode the risk involved. Inox Wind is not completely insulated from delays in execution, auction of more renewable projects, and increasing market share of independent power producers. In terms of financial performance, the company's second quarter of FY25 was strong on an annual basis. It saw revenues, EBITDA and net profit grow 14.6%, 27% and almost 80% on a year-on-year basis. The margins also expanded to 23.6% versus just 13% a year ago because of a better product mix. As for the 3-year performance, Inox Wind has been seeing a turnaround. Its revenues have grown at a 34.8% compounded annual growth rate over the last 3 years. While the company's EBITDA and profits were negative in FY22 as well as FY23, FY24 saw a positive EBITDA value and a contracted net loss value of just 71 crore rupees. The company's profits in FY25 so far are standing over 100 crore rupees. Going forward, the company has recently increased its EBITDA margin guidance from 15% earlier to 17%. With respect to FY25 performance, Bloomberg consensus estimates indicate that the company's revenues could more than double. Its EBITDA could grow almost 3 times. The net profit could be over 500 crore rupees versus a net loss just a year ago. Coming to valuations, Inox Wind's current EV to EBITDA ratio stands at around 59 as per Bloomberg. It is key to know that the company's valuations are expected to moderate and decrease to 39 in FY25, which indicates higher growth. Having said all that, what should you do? Buy or not? Well, the stock is being actively tracked by 6 analysts or brokerages currently. 5 of these analysts have given a buy rating and just 1 recommends a hold. And importantly, what's in it for you? Well, the average 12-month return potential stands at 21.8%. Now that you know, what is your view on the stock? Are there any other companies you want us to analyze for you? Let us know in the comments below, and do stay tuned to NDTV Profit for more.